Let us run a fair comparison. Says same dollars, same time frame. Real estate via 2 to 5.7 versus the S&P 500. The investor has $200,000 in capital and earns enough from their job to contribute $1,500 a month to investments over 10 years. Path A, 2 to 5.7 real estate year 1 2. Deploy $200,000 as down payments and closing costs across 5 properties worth $750,000 total. Loan balances total $562,500. Monthly extra payments of $1,500 begin in year 3. Over 10 years, total extra payments contributed $1,500 to 96 months, $144,000. Rental cash flow reinvested into payoffs, approximately $30,000 cumulative. Loan balances paid down by regular payments, approximately $45,000. Total debt eliminated by year 10, roughly $400,000 of $560,500. Remaining debt, approximately $162,500. Property appreciation at 3% a year. Portfolio grows from $750,000 to about $1,008,000. Net equity at year 10, $1,008,000 minus $162,500, $845,500. Annual rental income at year 10, with rent growth, approximately $47,000. No I minus roughly $13,000. Remaining debt service equal $34,000 a year cash flow path. B, S&P 500 Index Fund. Year 1, invest $200,000 lump sum. Continue investing $1,500 a month for 10 years. At a historical average of 10% annual return before inflation. Starting investment grows to $518,700. Monthly contributions, $1,500 x 120 months equals $180,000 invested. Grow to approximately $310,000. Total portfolio value at year 10, approximately $828,700. Annual income at 4% withdrawal rate, $33,148. The comparison, real estate net equity, $845,500 with $162,500 still in debt. Stock portfolio value, $828,700, no debt. Real estate annual income, $34,000 and growing as rents increase. Stock annual income at 4% withdrawal, $33,148, pretty close on the surface. But here is where real estate pulls ahead. 1. Tax advantage. Depreciation on $750,000 of real estate shelters, roughly $27,000 year in income from taxes. $750,000, 27.5 years. At a 24% tax bracket, that saves $6,180 a year in taxes. The stock portfolio generates taxable dividends and capital gains. 2. Inflation hedge. Rents increase with inflation. Your fixed-rate mortgage stays the same. Over 10 years, your real cash flow grows while your debt stays constant and shrinks as you pay it down. Stock dividends grow too, but you cannot control the payout. 3. Leverage. You controlled $750,000 in assets with $200,000. That 3.75x initial leverage amplifies returns. The stock market gave you $1 of exposure for every $1 invested. 4. After year 10. By year 12 to 13, all 5 properties are paid off. Your annual income jumps to roughly $45,050 with zero debt. The stock portfolio needs to grow to $1.25 million to match that at 4% withdrawal. The stock market path wins on simplicity, liquidity, and zero management headaches. The real estate path wins on tax efficiency, leverage, inflation protection, and predictable income. The 2 to 5 to 7 method is not a get-rich-quick scheme. It is a 7 to 10-year plan that produces free and clear income-producing assets. For investors willing to do the work, the math is hard to beat.